Good morning, everyone, and thank you very much for joining me. This is the morning market review. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address is rshaw@fxcm.com. Today is Thursday. It's not a big one. It's the 10th of March. I've got my days wrong. The 10th of March, 2022. I'll just keep this high risk investment warning on and just correct the date here, 10th of March. And here's our market commentaries disclaimer. And here is our references, Market Scope 2.0, CNBC. I'm not sure if we're doing trading view, but what I'll do is I'll bring up the chart. Here's gold. We'll take a look at gold in a moment. But before we do that, just going through the CNBC morning notes so we are aware of what's in the headlines. It reads as follows: European markets set to dip with Ukraine commodity prices, ECB in focus. European markets are set to pull back slightly on Thursday amid a volatile week as investors monitor the war in Ukraine and fluctuations in commodity prices. The Pan-European Stock 600 index closed 4.7% higher on Wednesday to notch its best day since March 2020, with commodity prices falling sharply from a recent surge in diplomatic talks between Russia and Ukraine, boosting global risk sentiment. Shares in Asia Pacific jumped on Thursday, picking up the baton from an overnight bounce on Wall Street, with Japan's Nikkei 225 jumping more than 4% to lead regional gains. US stock futures were little changed in early pre-market trade after the S&P 500 posted its strongest day since June 2020 during Wednesday's regular trading hours. Markets have been closely attuned to developments in Ukraine as Russia's invasion continues. Ukraine accused Russian aircraft late on Wednesday of bombing a children's hospital in the besieged city of Mariupol, despite a ceasefire deal to allow evacuations. Meanwhile, the Kremlin accused Washington of waging a de facto economic war against Russia after the Biden administration announced a ban on Russian oil imports. The UK has also vowed to phase out Russian imports by the end of the year. European investors will also be watching the latest monetary policy announcement from the ECB today. The prospect of surging energy prices exacerbating already high record inflation alongside a potential growth slowdown. This will pose as a headache for policymakers in deciding how quickly to tighten the ECB's historically loose policy stance. On the corporate front, Hugo Boss reports earnings before the bell on Thursday, while Credit Suisse releases its annual report and Deutsche Bank presents its investor deep dive. The paragraph that talks about raising interest rates during potential stagflation, that article, that paragraph to me is misleading. I've written what stagflation is on our insights page, so I encourage you to go and read. Stagflation is a policymaker's nightmare. There is very little you can do without some sort of adverse effect. You can either choose to control inflation, and that's going to lead to higher unemployment, or you can choose to control unemployment, and that's going to lead to higher inflation. That's the whole point of stagflation. It's a paradox in terms of economics. So I just wanted to clear that up. I beg your pardon. If you, I'll put the link to the article on Telegram as well. But we've done it in a fair amount of detail on Monday, so you can still go to Monday's recording, which is on Telegram. It's on our YouTube channel and etc. All right. Hey Howard, good morning. Welcome to you. I want to just go through to gold here. So gold has got this big inverted hammer. What am I talking about? It's not an inverted hammer. It's a gravestone doji. I beg your pardon. The Japanese candlestick names are so extravagant. Let's just try and understand the sentiment here. You've got bulls pushing gold up to the high for the week, and then of course losing control to the bears have pushed it down, or there's been significant profit taking. The obvious question is, well, why is there profit taking? Well, we're overbought, okay, but is there another reason? Is there something more fundamental that we can be talking about? And the answer to that is yes. We can go through to our UK oil CFD, which is a proxy for Brent. And I'm just bringing this up. All right. I want to go to our 4-hour chart here. That's how we looked at it yesterday. And well, look at this. Okay, this is very interesting because when we were talking in yesterday's morning market review, we were saying it looks as if the 4-hour momentum starting to wane, and then we spoke about some sort of potential exhaustion gap, and even hypothesized perhaps an island reversal. It's not a true island reversal, but the exhaustion sort of does come in here. Now, we still have to be very cognizant of the geopolitical crisis that's going on. The fact that the gap has closed doesn't mean that oil is necessarily done with its move. There is I haven't listened to it. I'm going to listen to it over the course of the morning. There's an interview that was done on Bloomberg yesterday with an analyst saying that oil could easily reach $150 a barrel. I haven't listened to the interview, so I don't know the ins and outs. I mean, that sounds extremely hard to me, but nevertheless, let's just go to the weekly chart here. So the point is that this gap has closed. The oil market is still overbought, and the gold market's starting to come down. Now, we have mentioned in previous webinars that we want to be looking at gold specifically as some sort of indicator in terms of the stagflationary environment. Okay, to me, it's really kind of the indicator that will confirm stagflation. If stagflation kicked in, gold becomes exceptionally useful in terms of a store of wealth. If the stagflation environment doesn't kick in, well, then I think the dollar actually, in my opinion, trumps the gold instrument in terms of economics, because then we can start talking about expansionary monetary policy. We can't really talk about expansionary monetary policy in a stagflationary environment. Why not? It's because of that trade-off. You're either going to address inflation to the detriment of unemployment, or you're going to address unemployment to the detriment of inflation. So there's still big question marks here. What I can say is that the overbought conditions for commodities and the oversold conditions for the risk markets are starting to correct. Okay, now the correction here doesn't change the trend. So we've gone now to DAX. Let's go through to this chart here. DAX, you can see, has the lower peak followed by the lower trough, followed by the lower peak, followed by the lower trough. There is an oversold market that is now correcting. Market participants have gone looking for bargains. This is an extremely, extremely dangerous situation, because I don't know if we're at the bottom. Nobody knows if we're at the bottom. And if we're not at the bottom, well, then this would be what we call a dead cat bounce, bear market rally. This is where the damage is caused, because everybody thinks that the bear market's over. They start rushing in. Then the next lower peak comes in, and then it's this leg down to the next lower trough that really does the wealth damage, because this sucks a lot of market participants back in. So we just have to be very cognizant of the fact we still are in a environment of lower peak followed by lower trough. We still have geopolitical risk. The fact that oil has corrected, the fact that gold has corrected, the fact that stock markets are correcting, just understand markets don't move in straight lines. There has to be a zigzag. So we're in the zag, right? The key here is, I think, in the short term, or not the short term, let's say sort of the sort of, let's call it the short term. The key here is to keep a look at the stochastic and see if the stochastic can make its way through to 80. That would be a positive development. Ultimately, what you want to see is a higher trough followed by the higher peak. If you get that, that is the definition now of uptrend. The bear market has effectively ended. Okay, so that's would be so we get the stochastic up towards 80. If the DAX manages to get that higher trough followed by the higher peak, that would be a defined uptrend. Another way for the bear market to end would just be an outright movement that takes out the previous lower peak. So yeah, that's exactly where the well, that's what a sucker rally is. I don't know if that is where the name comes from. I would suggest a sucker rally. It's not because they're getting sucked in. I think it's because they suck it. But anyways, you get the idea. We've got to be very vigilant that markets may seem cheap now, and there is potential that they are cheap. We may be at the lows, but we need to be cognizant that the damage in bear markets is done on these bear market rallies. Let's just go back to 2008 just to make the point. So we'll go back, let's just go 2008, back. Here we go. This is the global financial crisis. And just to make the point, let me zoom in over here. Okay, so we've actually, this is 2008. Here's that bear market rally, or that suckers rally. See, these are sort of sucker rallies. This one over here, I think, was especially vicious. This one possibly vicious. These are what trapped. This is what trapped the bulls in these false rallies, and then so we want to just keep an eye on these, not get ourselves into any trouble. The point is, okay, we may be at the nadir, the low. We may be there, right? But we may not be. One way for us to keep abreast of this is to keep an eye on the stochastic, see if it does pick up. First target, get over 50. That's into bullish territory. Get into 80. That's where the momentum starts building. That's where ultimately know that the bear market is effectively done. But we're still in this highly uncertain environment. So let's just keep an eye on this. On this, we don't want to get trapped. I also want to go down to the hourly charts here, because we want to just keep our eye on the moving averages and on the stochastic here as well. So again, if we get angle and separation on the exponential moving averages at the time that the stochastic moves above 80, that's the momentum building. That's the market participants buying those bargains, right? Let's just get a market rhythm in here. Let me go back. So let's do it from here. 1, 2, 2, 3. Okay. 1, 2, 2, 3. Now we get a nice one. This is a nice big one. 1, 2. Okay. Here's the 2, 3. Now the next step would be the angle and separation. Like you can see the green and the orange EMAs separate here, and the angle, they're moving northeast. Take a look at what happened with the stochastic here. Okay, the stochastic hit the 80 level and managed to keep in for a good few hours. We got that nice swing Okay, so what's lacking in today's DAX, we don't have the bullish cross yet. It's not to say it won't come. Okay, it might come, but if it doesn't come, and if we head down towards the 20, well, that's perhaps the reality setting in. Perhaps that's the risk-off environment starting to come back in. So we want to be very, very careful with not getting suckered into those rallies. Exactly what Anna's referring to. Okay, don't want to get sucked into that suckers rally. Now we'll keep obviously an eye on it. The weekly charts are still showing signs of danger. In other words, we still could have the lower peak followed by the lower trough. That would be very damaging to the DAX. We go through to gold here. Okay, we know that gold was overbought. Okay, it may just be some profit taking. Get the next higher trough, leading into the next higher peak. That would be indication of stagflation, right? In my opinion, because with the stagflation, gold becomes extremely attractive. All right, go through to oil. Remember, there's an interview I'm going to listen to on. You can go through to the Bloomberg Surveillance podcast, and it's there. But you just take a look at UK oil, and you can see that, well, we were terribly overbought here, and we still overbought here. What you can do is get a sizable pullback here, okay, and still have a higher trough leading into the next higher peak. The story is not finished yet, so we don't want to get caught in these corrections, okay? Something that may sort of happen is we may get something like this. Okay, if we get something like this, now there's a different pattern here. Now we've got the lower peak followed by the lower trough, okay? But we want to see where the energy is in the market. We want to see where the momentum is. So if we get the stochastic pushing through to 20, then maybe oil is starting to moderate. I think, you know, the reason that oil has pulled back over the last sort of 24 hours, there was an announcement coming up from OPEC saying that they will increase supply, but then it was kind of dialed back over Twitter, where I think it was the Saudi energy minister said they're going to stick to current schedules. So it's a little bit ambiguous at the moment with regards to what's happening. What does that mean? It means the uncertainty remains. We still are in the heart of geopolitical risk. A lot of it, I think, has been priced in. Now we're getting the profit taking, and then we're going to get the next movement based on the fundamental developments around that. Any questions? Please go ahead and type those in. I want to, yeah, we certainly can, Anna. I want to send the link for the stagflation article on Telegram. You can just go onto the FXCM homepage, click on Insights, and you'll see it's one of the articles there. And it's just asking to take a look at Euro US dollar, so we'll just bring that up. Okay, so top-down analysis here, Anna. Look for the zigzags, the heartbeat. 1, 2, 2, 3. 1, 2. And this is a weekly, so we're looking at primary trend here. 2, 3. 1, 2. Now, I wouldn't be surprised to see some euro strength coming in here. Okay, 2, 3. But then, is it going to make another leg down, or is it going to do something quite different? Make the higher trough, and then the kick up. So the ECB meeting today is going to be interesting. However, there is a real conundrum for policymakers, and that is the prospect of stagflation. Okay, that's not just going to influence ECB. That's going to affect all central banks, but all governments as well on the fiscal side. You've got generally theory says that the best thing to do in a stagflationary environment is to do nothing. But it's the quickest way to get voted out of power. It's political suicide, because the reason you do nothing is that there is huge pain associated with stagflation, huge unemployment associated with stagflation. Market forces indicate that the price of labor comes down. In other words, wages come down. As wages come down, the cost of production comes down. Your aggregate supply shifts closer back to equilibrium. And that's effectively the theoretical exit out of stagflation. The problem is that's political suicide. The prospects of lower wages, well, that can lead to a huge voter dissatisfaction. This prospect of that or higher unemployment, huge voter dissatisfaction. So how does the policy makers deal with that? And it's not an easy position to be in as a policymaker, because economically, stagflation is in of itself a conundrum. It's a paradox. It's high inflation, low growth, high unemployment. That's not typical. Typically, inflation is associated with an overheating economy, high growth, very low unemployment, high wages, or a recession, low inflation, low growth, high unemployment. Those can be addressed. Those you can address. Stagflation, inherently a paradox. One policy is going to hurt a variable, either on the x-axis or the y-axis. You just need to decide which is the lesser evil, and the truth of the matter is they're both very, very unpleasant. All right, how just taking just asking, I beg your pardon, to take a look at Bitcoin and US dollar Japanese yen. Let's take a look at US dollar Japanese yen first, and then we'll end off with Bitcoin. All right, let's take a look. Here's US dollar Japanese yen. All right, so this is a weekly chart. Let's get the rhythm in your head. 1, 2, 2, 3. Okay. 1, 2, 2, 3. Okay. Here's the next leg. 1, 2. Okay. Here's a sharp 2, 3. 1, 2. And now we kind of got a situation where, take a look what's happening here. 2, 3. Now this is the question. 1, 2. Is this, have we reached some sort of top here? Have we reached some sort of top here? Because it's obviously we can't tell, but the rhythm should give us a higher peak, and for it to continue in this type of a beat. That would imply US dollar over Japanese yen. The issue around this, of course, is Japanese yen is a safe haven, considered a safe haven. The reason it's considered a safe haven is because out of all the companies, Japan's debt is typically held by its own citizens. So that's one reason, whereas other countries' debt's held by other countries. The other market force which determines that Japanese yen is a safe haven currency is that because there are such low real rates in terms of interest in Japan, fund managers, portfolio managers shift a whole lot of yen offshore to earn rates of interest in other countries. But of course, when the risk increases, those portfolio managers bring the money back to Japan for safety, for safekeeping. They bring it back home, and that causes a whole lot of buying of Japanese yen. So that's another reason that it's just a sign of a safe haven. Howard, I think he's quite right. He says looks like there's some resistance here at 116. So let's keep an eye on that. I think that if stagflation recedes into the background, my feeling is, Howard, we move above this. So again, what happened here? I beg your pardon. I'm sorry about that. So my feeling, this is just like gold, is a good. Besides looking at it in terms of investors or traders, it's a good indicator in terms of where we are in terms of the stagflationary environment. Well, US dollar, Japanese yen probably is as well. And then just to end off, we'll go through to Bitcoin here. All right. This is a difficult chart to read because it's uncertain. It's uncertain. The analysis we did in yesterday's Crypto Minute, to me, hasn't changed. I know there has been an announcement in terms of regulating digital currencies in the US. I don't know if that's a good thing or a bad thing. The whole point about digital currencies is that they're meant to be unregulated, which I think is a bad thing. Which, but I could be on once. I'm not trying to convince anybody. Somebody on the other side must say, well, Russ, you're talking nonsense. It's a good thing. But I'm not sure regulation for the digital markets is a good thing either. Price is going to dictate ultimately, if I should be bullish or bearish on this. And right now we're consolidating. Okay, right now we're moving sideways. We've still got this pennant, which we talked about yesterday. We've still got the prospects of a head and shoulders, which we talked about yesterday. We still got the prospects of a double top, which we spoke about yesterday. But a movement over here negates all of those. Okay, a movement down this side puts us in more danger of those patterns completing. So you can see we are in an ominous period here. The idea is, look where the stochastic is. The longer we stay at 20, the more pressure is going to build and push the crypto down. If there are crypto bulls on the webinar, the best scenario is to get the stochastic into the 80 area, because that would be a signal that there is an underlying bullish momentum that's building. So that's what we've got to be looking at. And it says the initial excitement there was that Bitcoin wasn't banned. So that could be the initial excitement. I'm not sort of I don't know where this regulation is going to take us. I'm not sure if banning isn't still on the cards or not. I mean, we'll just have to wait and see. The one part of the announcement which I found encouraging was, of course, that they're trying to get rid of the scams. It's a lot of crypto scams. You see them all over the place. All right. Anyways, if we take a look at the current weekly candle with the admission that it's still an open candle, it's got still a number of trading days before it completes. And remember, the cryptos trade over the weekend. And just take a look at what type of candle this is. It's a doji. It's a doji. It's a candle of uncertainty. So we've got uncertainty inside a pennant. Okay, so we've got to just see which way it decides to go. A breakout to the top side would be positive. We want then the stochastic to move to 80. A breakdown to the downside really is negative. And if we stay at the 20 area, I think that's going to be quite painful for the cryptos. But as it stands right now, uncertainty. And if you take a look at where price is over the last 2 weeks, even call it 3 weeks, we're just hovering around that 38,900 level just for 3 weeks, with occasional sparks up and down. So you can see that how it's just written here, daily may have a bearish engulfing forming. Let's just take a look there. Bringing up the daily. I mean, it's definitely an inside day, right? Which is that uncertainty that we've seen. Even if you don't call this a bearish engulfing, what you can do is you can combine these two candles. Now, again, there is a risk here. This is not a completed candle. Okay, this is a daily candle. We're not going to know what this candle really looks like until the end of trading day. The trading day, in other words, there may be a whole lot of bullish sentiment that pushes us up, and who knows, maybe we get a tremendous blue candle here. But as it stands right now, instead of looking at it in terms of a bearish engulfing, the way that what I would want to do is combine yesterday's candle with today's candle, just to get an idea of the sentiment. So what you can do, Howard, is you'll just draw a range, which would, so the range for the two candles is actually dominated by yesterday because we've got an inside period, right? But then if you take a look where the open is relative to the current, what do we have here? Got a big selling tail here. So even though it may not be a bearish engulfing, it's still got a bearish selling tail here, doesn't it? So the sentiment there, Howard, certainly as it stands right now, would be there's a bias sort of towards softness, isn't there? So we're just going to have to, again, the big caveat is this candle is still open. It may turn out to be that bearish engulfing. Then what happens is, this extends downwards like that. But even without that, it's still got this big selling tail here. So we just, the idea here is, well, hang on a second. Why have we got this big selling tail in Bitcoin? Isn't that meant to be pro or positively correlated with risk? Aren't we in a risk on environment just over the last 2 days? We'll be able to answer that a little bit later. And of course, we'll come back to that tomorrow. Yeah, big difference between the two candles. But Anna, let's see how it goes. We still got, we don't want to. I've got to be very careful when I say we. I want to correct that to I. I'm not a crypto fan. I'm just not. I don't see the value in crypto. I don't see the intrinsic value. It's a bias. Okay, like I do have a bias, which can it can impinge on my analysis. So, I don't want that bias to overpower the analysis. So what I'm trying to do is I'm just trying to take a look and see, is the breakout to the upside, is the breakout to the downside? And if it's a breakout to the upside, well, clearly that's bullish. There must be something driving the breakout to the upside, and we'll need to discuss that. If there's a breakout to the downside, then there's obviously something that's determining that. We're going to have to discuss it. Right now, as you and I speak, we're in a range and we're uncertain. And let's take it from there. Thanks, Anna. Thank you very much. All right. Any other questions? Any other questions? Nothing. You guys have my email address, so send me any emails you'd like to. I'm going to put this recording on the TradingView. I beg your pardon, not TradingView, a Telegram channel, and I'll put the link to that stagflation. I hope that it makes sense. I try to make it sort of as easy a read as possible. I'm not sure if I've succeeded or not, so you guys can obviously come back to me with that. All right, guys, let's wrap up here, and we'll speak tomorrow. Thank you very much for your time this morning. As always, very much appreciated.